Going here. Okay, welcome everyone to Jim Dalton's presentation, Run for the Roses, Navigating Year-End Trading. This is the first of 5 webinars that we'll be doing over the next several Mondays until Christmas. We're coming up on 6 years of doing this here at J. Dalton Trading, sharing Jim's work with the trading community and fellow traders. And it's really an honor to have all of you here today and have the opportunity to share Jim's work with you in real-time markets with no textbooks. So Jim and I want to thank you all for taking time out of your busy schedules and sitting in to learn here and listen to Jim. So this webinar is being recorded, and we're going to do preparation. Jim will quickly walk through his preparation for the morning of the day of trade, and then we will watch and listen as Jim will narrate live trading once the New York Stock Exchange opens at 9:30 a.m. Eastern. We probably in this hour will not have a lot of time for questions, but Mr. Dalton will take some questions over the hour. So our apology in front of that if we can't get to your question, but you're welcome to email us or call us or come on the next webinar or one of the subsequent webinars here and get your questions answered. Okay, so thank you again for being here. It's really neat to see all of you. We have a full house and we were over registration. So we're excited to get going. And with that, I will turn it over to Jim. Good morning, Jim.
Good morning. Thank you, Julia, and thank all of you. I don't know how many are here for the first time and how many have joined us in the past, but welcome to all of you. I'm going to start right in. I mean, the idea for this is Run for the Roses, just trading coming into the end of the year. Historically, that's only historically, the period from Thanksgiving in through the end of the year has been strong. However, this has been a very unusual year. The market overall has moved sideways all year. You may remember that just a week ago, come Thursday and Friday, the market looked like it was really going to get hurt. We came into last Sunday night, the market opened down sharply, and of course, by the time the end of the week, we saw the best week of the year, at least from a percentage in some of the indices. So I mean, it's a crazy market out there. A lot of uncertainty, and it appears to me that the longer time frame money has basically been on the sidelines, which then leaves the trading in the hands of the controlled by the short-term traders. And I define short-term traders as those traders that are trading overnights, maybe 5 to 10 days at a time, but they have to be respected. They have a tremendous amount of money. They can move very, very quickly in the markets. Not only do they have a lot of money, it's highly leveraged money. Being highly leveraged means it's going to be very volatile type of money, and that's exactly what we have seen. Now, what I want to do today, I want to set the stage because we're going to go into live trading once the market opens, but I want to set the stage. And what we do when we get ready for the day, we look at the monthly bar, the weekly, the daily. We always do a top-down approach to get some perspective of what's going on. Then we go to the recent profiles, then we end up with the prior trade and market profile to look at what expectations we may be looking at for today. So we start off right away. When I look at the monthly bar chart, you can see that we had a big break earlier in the year, and when that happened early in the year, the first thing that came to my mind that this could have been the start of what we call the bracketing process. Markets do not go from bull to bear very often. They generally go from bull to balance, back to bull, or bull to balance, back, reverse to bear. So as it turned out, this was, while it was months ago, we did come back down, and we now are in this balancing period. So it's a multi-month balance, very little change for the year, but we came down, usually the first time down to the balance area low, you will get a bounce. That's probably in the 90 plus percentile. Then once we bounce off the bottom, the target becomes the upper extreme of the trading range. And of course, we're in that upper extreme right now. So from a monthly, looking at it from a monthly, we are in a balancing period, and that has gone on for 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, about 15 months. So it's a sideways move, big congestion period. Trade location now is near the upper extreme of that multi-month trading range. Next, we go to the weekly, and when we look at the weekly chart, we will see that the weekly was one time framing higher for 1, 2, 3, 4, 5 weeks. Then the market broke, and I'm not sure this exactly coincides with my dailies, but it's pretty close. But now we basically have a 2-week balance. So we've got the longer term is in a bracketed or balancing market, and at the weekly, we also have a balancing situation. Now we come and we look at the dailies. The daily has been one time framing higher, and if in case you're not familiar with that term, one time framing means that the second bar here took out the high of the first bar. The next bar took out the high of the second bar, but not the low. Third bar took out the high, but not the low. So we've been one time framing higher on a daily by 1, 2, 3, 4, 5, 6 days. So we've been one time framing higher for 6 days. If there is to be any meaningful change this week, the first thing that you would expect is to see the market stop one time framing. That means that we would trade down below last week's low. Or and in this, I'm sorry. In this case, below Friday's low. So I can, by looking at this right now, my early focus for the downside is going to be on Friday's low. So once we have looked at the monthly, the weekly, the daily, we now go to the profiles in order to get a better perspective of what is happening on a very short-term basis. The bar charts give me a broad perspective. When I move from the bar charts to the profile, that is like putting the market under a microscope so I can get a closer look at what is really occurring. So this is last week. This is Friday. And Friday, as you can see, was pretty much of a balancing day. Point of control, meaning the longest line reading from left to right, point of control, or also considered the fairest price at which trade was being conducted, took place just about in just a little bit below the center of the range. So it was fairly much of a balanced day. When you take a look from the morning report, this is a report we put out this morning, you'll see that the overnight trade took place pretty much within within Friday's range. So Friday was a balancing type of day. The overnight activity was pretty much of a balance. Overnight inventory is pretty close to being equal, and we look very closely at overnight inventory. We know that about 65% of the times, if there's out of balance from overnight inventory, that inventory out of balance is corrected early in the morning. So as we get ready for today, we're saying that just review, the monthly shows that we're in a balance, but we've come from the lower end of the trading range, which took place 14, 15 months ago. We're up near the upper extreme. The weekly shows that we are in a short-term balance. The daily shows that we have been one time framing higher for the last several days. Friday brings us into short-term balance. So if we're getting ready for today, what we're going to be looking to see is what happens today? Do we trade in or out of balance coming into today? We talked about overnight inventory. It's in or out of balance. Now, what I want to talk about here for just a second. Right now, we would anticipate that the market will open about centered within Friday's range. If the market opens centered or about centered within the previous day's range, there has been no real change over the weekend. The market is within short-term balance. When the market is within short-term balance, as what we're seeing today, generally I sit back and I let the market work out what it wants to do today. When you get this type of situation, you normally get a tremendous amount of chop early in the morning. This chop can be exacerbated on a Mondays because we have almost always anymore, we have options expiration that takes place over the weekend, and early on Monday morning, we get to the point where those exercises have to be, whoever got unexpectedly exercised or more than they inventory, they end up more inventory than they really want, has to be corrected early Monday morning. So as we sit right now, we probably will have some adjustments that have to take place as a result of the options exercised over the weekend. We now also know that we're within about the center of Friday's range, so more than likely we're going to open within balance. Open within balance, you're generally better off to sit back, just let the market chop and make its own decision. Trader mindset is the slide you're looking at. What happens so many times to traders is they get very geared up, very hyped for looking for the first trade of the day, afraid if they're going to miss the big trade of the day if they don't trade early, and it's not uncommon to have traders do several trades early on, lose money, and also wear out their financial reserve, or psychological reserve early in the morning, and then not really set up for the remainder of the day. If you find yourself frantically looking for a trade, being afraid you'll miss the next opportunity, you are more than likely blind to what is really going on into the market. Once you reach that stage of too much anxiety, getting too anxious, too mentally blind, you are in a very dangerous position. Even if you get the right trade on, more than likely you're not going to manage that trade correctly. So for right now, my first thing I would suggest this morning is we be prepared for a little chop and letting the market set itself up. Okay. We're going to come back to this slide a little bit later. What I want to do now is I want to back up for a little bit. Hold on, let me see if I can get back to where I want to be. Okay, we're going back to one of the earlier slides. This slide shows the market. You don't see the bottom of it, but you saw it on the bar chart. The market's been one time framing higher. We then got a balancing day on Friday. Coming out of a balancing day, you generally want to go with any breakout from the balancing day. So one of the things that we do in order to stay objective in the market, and it's very easy to lose your objectivity, we have what we call the balance trading rules. When the market is balanced, you basically have the following that can take place. The market remains within balance. So if the market remains within balance today or remains within Friday's range, more than likely what you're going to get is a rotational trading day. Rotational trading days, you'll get a lot of chop, you'll get little opportunities, and you either plan for that. You don't look for home runs. You look for the short-term trades and expect more trades, more opportunities, but less potential on each trade. So the first thing that can happen is that you remain within balance. The next thing that happens is you can look outside of balance and fail. So for example, if the market looked outside of balance to the upside and failed, then the objective becomes the opposite extreme of that balance. So if we look to the upside and fail, meaning come back in, then the objective, or what I call the destination trade, is the lower end of the balance. If we look below Friday's range or below the short-term balance and fail, then the objective becomes the upper extreme of the previous day's range if we're using a one-day balance. The next thing that happens is the market goes out of balance and moves directionally. So if we come out of balance relative to Friday and move directionally, that maintains the current short-term auction to the upside. If we come out of balance to the downside, the first thing that you begin to focus on is the potential for market change. Trading is about change. Without change, there are very few opportunities, at least good opportunities. The best opportunities come when the market is in the process of changing. Change is welcomed in the market, it should be welcomed in the market. However, as human beings, we abhor change. We don't like change. As traders, we should welcome change. So whoops. I don't know how I did that, my fat little fingers. Okay, so we should welcome change. To the downside, if we break out and we start to move directionally to the downside today, remember, not look down and fail, but start to build value and extend below Friday's range, then that's an indication that change has taken place. We already saw we've been one time framing higher for the last several days. If we now begin to trade to the downside, change is in the works. The biggest opportunity comes when the market is moving out of balance. We have a short-term balance on Friday. We move out of balance to the downside. That is an indication of change. You haven't confirmed that change yet, but it's an indication that it certainly is a potential. On the downside, you have a point of control, or remember, its point of control is the longest line reading from left to right on the profile. When they are very prominent or stick out like a sore thumb, the odds are always very high that they will be revisited. Additionally, last Wednesday, you had a market that went straight on up with a lot of anomalies. Anomalies are just uneven areas within the profile. Very often, when you see these anomalies, this is an indication that you have a lot of emotional trading, and that emotional trading very often comes near the end of a market auction. Doesn't have to happen, but I'm alert to the fact that the underlying support of this market is not particularly good. If the market should be this week begin to trade down below Thursday's low, there's no real backing and filling to slow this down. So this market could move very quickly on the downside. Okay, before we go back to the look at the markets and where we're trading overnight with just a few minutes prior to the opening, we start and we say Friday was a balancing day. The one point that I want to remind you of, on Friday there was a very prominent point of control, and it is the bigger the point of control, the more prominent it is, the larger the odds that we will trade back and check that point of control out. It didn't happen on Thursday, so it's what we call information we carry forward. Know that it's there. We have another point of control on Friday, pretty good odds that we go back and revisit that today. Okay, let me go to the profiles, and once again, let me show you something else just before we do this. you see the same thing. This is a profile we just looked at on the left over here. On the right is the SPY. And what we want to show you is that whether you're trading futures or whether you're trading SPYs, the profiles are almost exactly the same. Basically, what is the SPY? It's 1/10 of the E-mini future. So again, it's so many times people think that we are concentrating on futures. We use the S&P futures as our foundation for learning and education. A lot of traders, even if they don't trade the S&Ps, look at the S&Ps to see if there's anything significant that has gone on overnight. If there's nothing significant, then they may move away from them and trade whatever their favorite market is. If there's significant change overnight in the S&Ps, it's a pretty good indication that we're going to get some major change someplace in the market overall. So, but if you're trading the E-mini or the large futures contract or the SPY, the futures contract and the SPY contract mirror each other. It's just that there's a difference in size. And a lot of you may not know the SPY came from the original OEX, which was the index on the CBOE. And I was basically the person that came up with the idea for the OEX in the first place. I didn't develop it, but I came up with the idea when I was executive vice president of the Chicago Board Options Exchange. So our history goes back a long time in these markets. All right, I'm going back to the full S&P contract, and then we'll take a few questions. So right now, the point of control from Friday was right there at the 2087.50 level. We are still within Friday's range. We're still fairly close to the center we've opened right now, fairly close to the center of the range and pretty close to the point of control. So right now, my expectations to start the morning are not high. My expectations are that we're going to get some chop early. Julia, let me take a couple of questions.
Yes, thank you, Jim, very much for that. Question about how long do you see that longer term money has been on the sidelines given the rally, in the break? But do you have an idea of that?
I haven't, but it may not be correct to say how long have I seen them on the sidelines. They may have their basic overall commitment to the markets, and they may be comfortable with that. I haven't seen any substantial change for the last year in the market. As you say, that's consistent because we've moved sideways. That doesn't mean that within their portfolios there haven't been shifts from one industry to another. But I haven't seen any real indication that they want to put more money to work or they want to raise cash. It seems to be a fairly stable market for the last year. Overall volatility has been low, but I haven't seen any great shifts. When the market did break, as we know, the last time it broke about 5%, another time it was about 10%. We did see some commitment of money coming off the sideline, but I haven't seen any real shift in their attitudes, overall attitudes. That doesn't mean there hasn't been, shifts in industries, but overall commitment to the market, I haven't seen any of that in over a year.
Okay.
Nice question.
Yes, thank you, Jim. And a newer trader here, or maybe new to your process, how do you judge the difference between a failed breakout and a successful breakout from balance?
Well, you'll find acceptance. In other words, if we break to the downside today, you will find that value and price will find acceptance down below Friday's range. It'll occur over time. And part of the reason that you saw a slide earlier, and that slide earlier, and we'll come back to it later, but it was on a new book called Nonsense. And nonsense is the #1 book relative to trading markets that I have ever read. And in fact, it's not about markets, it's about psychology. And it's about our need for certainty. The premise of the book is really, how do you unshackle yourself from this need from certainty, this discomfort you have with ambiguity? So the reason I bring it up here now is this, there's no exactness. What we want in the market, we want exactness. We want to know, where do we get in, where do we get out, where we put the stops. I don't have that information. I don't have that information. But on a broad sense, we talk about change. What really happens? So when you think about this, breakout, we can look below Friday's low, for example, and we can be accepted. So over time, we see price remain down there, and we see value, which represents 70% of any day's trade, building down there. You'd start to see it building down within Friday's or within Thursday's range. You say, okay, we have a downside breakout from the balance day on Friday. If you look down here below here and you spike back, you quickly get rejected, come back up. Now you didn't have any change. So it's something that develops over time, but it's not exact. Okay, nice question. Additional questions here in the last couple minutes.
Yes, thank you, Jim. Can you mark the high and the low of the pit, just so we have those balance areas identified? And once we start trading in the real-time profile, there'll be volume there beside price as well, similar to what you see on the overnight profile with histograms. So using volume and tempo and how it got down to the low or the high goes up to the high, Jim's looking at that as well. It's difficult to give an exact answer, but you will get a sense of it. Hopefully today we'll have the opportunity to hear Jim narrate that.
And here, what I'm going to narrate when this market opens, what I'm looking for is confidence. And, for example, several days last week, the market opened and tried to trade lower. The tempo, the slowness, it was just sluggish. It would go lower, but it would be very sluggish. And I would say, okay, the confidence trading lower was very low. And the market each day turned and traded higher. So what we're looking for is to see if there's any indication of confidence, so we have some idea what the market may do. And I'm going to talk through that confidence, and hopefully correctly, once the market opens. So right now we're going to open in about a minute. We're just a point from the point of control. Okay, the market is open. We're going to leave the overnight up, and we're going to watch and see if any indication of confidence shows in this market. So far, I don't see any indication. We are trading within Friday's range. We're trading within the range from the overnight. In here, one of the indicators, short-term indicators, is unchanged. Unchanged is up here at the 2088.50 level. So right now, there's the opening. Let me get rid of some of those. So here's the opening, the green light, a green little arrow up there. First attempted direction, very meager, but it's trying to go lower, but nothing, there's no great confidence in there. We have not traded at the point of control from Friday. So now this is what I'm talking about right here. I see nothing that I want to do. I just sit there and say, let the market settle. Let the market chop. Don't give up your capital, both psychological and financial here. All right, first little attempt was to the downside. Second little attempt, we're back up. We have tagged the point of control from Friday. We have not traded to unchanged yet. Okay, so we're watching right now to see if we see any semblance of the market trading out of balance. If there's any real opportunities today, the market will trade out of balance relative to Friday. So far, no change from Friday, no change over the weekend, and no change early this morning. A couple of questions while we're watching this, Julia.
Yes, Jim, can you slide your chart down just so we can see the highs there? Thank
Okay.
you. Any significance do you see with the overnight low being one tick off of Friday's low? So, just so people aren't familiar, Jim would term that as, quote, weak in that the market came down there.
Well,
Any significance?
what it tells me, and there's just a lot of common sense when you're talking about trading. If there was any really serious buying coming in here, saying long-term buying, they don't wait till one tick off of Friday's low. We're always looking to see who are we competing against in the market. When the market trades down to a single tick below Friday's low, the odds are that those are short-term trading money that would try and be that exact. As I've said many times, I used to run an institutional trading desk, and as running an institutional trading desk where you might have, multi-million share orders, you never wait until you're a single tick from some reference. The behavior, the people that wait for the single tick from a reference, those are the shortest of traders. They're daytime frame traders and they're short-term traders. They're very opportunistic traders, and they're generally smaller in size. So when I look at that, I say, okay, the market stayed within balance from Friday. Overnight went to a single tick from Friday's low. No great thing. I probably had traders that were doing some covering there, short-term traders, but probably not an indication of more serious type of money. Okay, now I'll take another question in a minute, but let me point out now the market's been open 3 minutes. It is a very, very narrow range. So you remember the first thing we said, when you've got an opening within the previous day's range, you generally are better off just to lower the anxiety, sit back, and wait your opportunity. I don't know how many people out there have already done one or two trades already. I'm sure there's people watching this that have already done one or two trades because they're very anxious to trade. And like I say, when you get that anxiousness, it's very often you become mentally blind to what's really going on in the market. Okay, so now we went exactly to the point of control, to the tick. Okay, again, indication that's kind of what short-term traders look for. So right now we're still within Friday's range. This is kind of the second little test looking to the downside. But no, I see no confidence yet. Another question floating around there, Julia.
Yes, thank you, Jim. I see the November 20th, Friday and the overnight low stopping just above the value area of Thursday, November 19th. Is that something you see a lot in the profiles or that you pay attention to, Jim?
It's not something, but you can always find things to look at. Most of the time what we do, we over-search for references. We over-search. What's the big question today? The big question today, are we going to be in or out of balance relative to Friday? Now, what I want to come back to right now for a second. Remember, I said if there's any meaningful direction one way or another, the odds are always very good that you're going to come back and revisit a prominent point of control. And a prominent point of control is going to be something it's going to stick out more reading from left to right than most of the other lines on the profile. So having revisited Friday's point of control, if the market went lower, then you at least have taken care of and revisited that point of control. So that you can kind of scratch that off your list. Also notice here early on, you got the point of control. You did not get to unchanged. Now we're trying to trade lower right now. One of the things I said I look for confidence. I don't see any confidence in this market yet. I have nothing exciting that's excited me yet. Market opened, tried to go lower. It came back up, it went through the opening, original by a couple of ticks, tried to go lower. There's no real tempo in there. I don't feel anything that really says we're going lower. Now, I'm carrying a bias because I think overall, I think the market is I think the market inventory in the market, I think is dangerously long. That's my personal view. But you don't want to fight the trend. Okay, nothing has changed the trend so far. We opened with imbalance from Friday, but so far there is no real confidence, and we're still within the balance. Okay, other questions?
Yes,
So
thank you, Jim.
my number one objective today is, do we trade out of balance?
Right. Thank you, Jim. And we're gauging value as time passes, value will develop. If you want to comment on that at all, or we'll move on.
No, I will. I'm always looking to see, where do I think value is going to develop today? Do I think it's going to develop unchanged? Here's Friday's value. Unchanged would mean, does it overlap? Will it be overlapping to lower? Will it be overlapping to higher? I'm always asking those questions. Right now, my focus is on remaining in or out of balance relative to Friday. Right now, as I said early on, when the market opens with imbalance, more than likely what you're going to do is get a lot of early chop. Early chop is one of those things that will really hurt traders substantially. It's just, a little loss here, a little loss there, but it's not only the financial loss, it's also the psychological loss. So when the better trades come up, you may have worn yourself out. Another thing is, when you trade in the morning, particularly a day like this, when you're trading in balance, you have to try and lose this fear that you're going to miss the best trade of the day. So what? If you miss a trade, so what? I'm sure it's the first time it's ever happened to you. Now, if the market opened out of balance, meaning outside of the previous day's range or closer to the edge of the previous day's range, now your anxiety level may rightfully go up a little bit, because there may be a more urgent need to trade. The biggest opportunities come when the market is outside of balance. Okay, so now this is the third time we've seen the market open, went lower, came back through the opening, went lower, very slow, came back up, rallied a little bit again, and now this is the third time they're trying to push it to the downside.
Jim, the question has arisen, why are you saying the market is dangerously long?
That is my personal opinion. And I'm saying it's dangerously long. If you come down here, a lot because of the way this day traded, very thin, all these different anomalies, different distributions. The shape of Thursday, which was a balancing day, very fat, and just, no real conviction in here. And then Friday had a chance to go higher, but the point of control did not migrate higher. So, but that doesn't mean, remember, the trend is up. But that's my feeling, just as Julia and I do a conference call with an institution every Monday morning.
Sunday morning, I'm sorry. A week ago, Sunday, on that call, I said the market was dangerously short. Now, was I saying to go long? No, but I was saying that the risk of being short was excessive. Let's go back and look and see what the market looked like that led to maybe compress them. Beg your pardon, excuse me, but maybe compress just
okay.
Get a little more perspective.
Okay.
Thank you.
Here was the market coming. Let's say this was last week. There was Friday, Thursday, Wednesday, Tuesday, Monday. So the previous week, it was the market coming down. You had a gap, and you had a point of control that was fairly prominent up here. You were followed by a second gap. Notice the point of control is still way up here. So in other words, you were getting this telling me, as I'm getting this emotional selling, but I'm not getting anything more than emotional selling. In other words, I'm not getting a combination of new money selling and liquidation. I was more than likely getting liquidation and getting emotional selling. And gaps, it's very unusual to have two back-to-back gaps. And you can see the market, again, look at the point of control on a week ago Friday. It remained high while price went lower. And incidentally, I don't expect you to understand everything that I'm talking about, immediately if you're not familiar with what we do. Julie and I we will announce in the next day or two what our educational program is going to be for the first half of this year. And within that announcement, we're going to have two educational intensives that we've done in the past. But that's what we teach in the intensives. How do you get a sense? How do you get a sense of when that inventory is getting too long and too short? It's not something that comes from an exactness, and it's not something that you can always act on immediately. When the market went down earlier, there were 4 gaps to the downside. That was when the market made its most recent big-time low. And I said, I've never seen 4 gaps like that. And it looked like it was being overextended. Well, the problem is, I could have said that after 2 gaps, 3 gaps, etc. So you have to build in some resistance to act too early and be able to read the markets on a short term when it's ready to go. But that led to a huge rally. So this is, if trading is not something you paint by the numbers, it's not something you're gonna learn easily. Most people don't show you the right information to look at. They want to do it by numbers. Julia has written a piece, you try and do it by the numbers. You're trying to take the human element or the humanity out of the market, and it doesn't. The market is made up of people making decisions. They're people like you and I. Sometimes we do what they do, sometimes we don't. So it's a process to develop it. But thank you for the question, but it doesn't have to be acted on immediately. Yes, I think it's dangerously long. That's a personal opinion. Does it have to be acted on today? No. I thought a week ago, I thought the market was too short on Thursday. It got even shorter on Friday. It got even shorter on Sunday night. But it's to be aware of, and you think in terms of odds. For example, on Friday, the market opened on Friday and started to trade up. And what I told Julia on Friday, I said, I'm going to leave the market. I'll be back in a while. I'm going to go up and work out. And why did I say that? Because I was very certain that the market was going up on Friday morning. I could see the way the market opened. I could see the way the overnight traded, particularly just coming into the open. I was very, very high odds that I thought the market was going up on Friday morning. Yet my personal decision was I thought there was too much underlying risk. And I thought, even though I was very sure it was going higher, I knew if I got long, the chances were I would be too nervous. If I get too nervous, then I get in and out and I do some silly things. So I just walked away from the market. I'm going to go back and I'm going to split Friday out for a second.
Market profile. No, yeah, right there. Yeah.
Market profile.
Thank you.
And expand profile. So this is what, and this is like when I made the call to Julie. I said, I'm walking away. I know it's going higher, but I'm just not going to participate. And so I came back, as the market, after the first hour, I came back, and you can see what happened. Then the market was weak, but it didn't do any follow through. So those are decisions that we make. Okay, I'm going to collapse this.
Thank you.
Going back to today. Remember, early on we said that the confidence did not appear to be high. The market opened, the market traded lower. Market came back through the opening, traded lower again. They tried it a third time. They never really got anything. We said that the point of control was a short-term reference, and we said that unchanged was a reference. There is unchanged. Right now, the market is trading basically at unchanged. So what happens, it's a continuous two-way auction process. The market, we said, when open within range, more than likely there's going to be a lot of chop. It tested the downside, didn't find anything. Came back up to the opening. Now it's testing the upside. Is it going to find anything on the upside? Unchanged is a very visible. Markets are very visible the way they trade. In other words, they trade to points that people can easily see. Previous day's high and low, the overnight high and low are always references we use. Unchanged is a reference. Now that the market is open, half back, which is the white line here, it's another short-term trader's reference. One of the things you'll learn as we go through, if you join us for this educational program, first half of this year, we're constantly trying to help you understand what your competitors are doing. Sometimes you want to be with your competitors, and sometimes you want to fade them. This morning, when we look at the market this morning, I don't see any indication so far of anything other than short-term trading. We open, and I said early on, the odds are you open with imbalance. The odds are that you're going to get a lot of chop. Have we gotten a lot of chop? Yes, we've gotten a lot of chop. We said that point of control from Friday is a reference. Unchanged is a reference. We tested the downside 3 times, nothing. We've come back up now to unchanged. We've traded 1 tick above unchanged. That is not a sign of strong selling. Mechanical, it's a mechanical reference, and there were traders automatically selling it unchanged. First, there were traders automatically taking the market to unchanged because it's very visible. There's other traders automatically selling it unchanged because, oh, we're back to unchanged. I see no indication of any confidence in either direction so far this morning. I've had no desire to do any trade. I would much rather let this early trade just work its way out and say, hey, if I miss a trade in here, I miss a trade. So what? That's an attitude you have to develop in the market. Once you develop that attitude, if I miss a trade, so what? Then you have much less odds or lower odds that you're going to get over anxious in your trading. So right now, everything we talked about, this was, we got very lucky. The day has accommodated us very nicely on here. Now we're looking at unchanged. We've not tested the overnight high or low. The overnight high and low are very likely targets for the market. They're very short-term type of references. So now we're getting a little more aggression on the upside, trying to go higher. Okay, we said we notice how it stalled at unchanged, very mechanical reference. Now think about, there's early on everybody must know, is there long-term money in here? Do you think if there was any real long-term money of interest, they're not going to hesitate. They're not watching unchanged. They probably don't even know what it is. This is trader. When you see this is short-term trader references. Okay, they looked at unchanged, 1 tick above it, little sell-off, no follow-through, so they came back in again and they get a little bit more aggressive on it. So now the market now is trying to get to the overnight high in here. But again, there's a lot of chop in this morning. Traders are very anxious. Oh, boy, let's try the downside. Oh, it didn't go down. Let's try the upside. One of the things that we continually talk about is the market is a continuous two-way auction process. What the market profile does, it organizes that continuous two-way auction process so we are better able to read and appreciate what is going on within all of that chop. And we're not, I'm going to make sure that people understand, we are not market profile traders. We are full-fledged traders. We use the market profile to organize the market's data. People using a bar chart only see basically price. They see one dimension. When we look at the market profile and we look at the continuous two-way auction process, we are seeing at least a two-dimensional view. We're seeing time and we're seeing price. So we're looking at it differently not so much in a vacuum as when you're only looking at price. We're seeing it differently because we're seeing at least two dimensions, and that's time and price. And if you then, when we add volume to it, when you add volume to it, you're now looking at it in a three-dimensional: time, price, and volume. The basic premise of all the programs that we offer are that it's a continuous two-way auction process. In an auction, price advertises opportunity, time regulates all opportunities, and volume measures the success or failure of those advertised opportunities. That is consistent within any market that is financial in nature. Okay, so now we're just about, we've got 8 minutes till the end of the first half hour. So somebody could on and say, well, why did I come on this opening webinar? There's nothing taking place. Well, is there value in somebody saying, I don't see any real opportunities early this morning? And we were saying, this is what we wrote in the reports, early this morning. This is what we talked about. And it's basically, it says, hey, traders, cool your jets. There will be better opportunities as the days go on. But for right now, we're still well within balance. We haven't taken out the overnight high. We haven't taken out the overnight low. Value is right now building a little bit, slightly overlapping to lower. It's too early to make that call, but we'll watch and see what happens as the day goes on. The big thing, if there's any change coming to start the week, remember, the short-term trend has been up. The market's been one time framing higher for, here's an outside day of the upside. So 1, 2, 3, 4, 5 days. Moving sideways today does not stop the one time framing. In other words, stop the one time framing, you're going to need to take out Friday's low and find acceptance below it. As of right now, there is no change. We thought Friday was a balancing day. We're starting the week, and so far, Monday is a balancing day.
Okay.
All right, so go ahead.
One time framing would stop whether there was acceptance or not if we take out the low on the daily profile.
If we take out Friday's low, one time framing would have ceased. And we have to take it out by a couple of ticks, not just a one tick aberration. But taking it out and stopping one time framing is first the alert to the potential for change. It has not confirmed the change. It's only an alert for the potential change. Okay. In order to increase the odds that change is underway, you would start to see price acceptance and value building below Friday's low and doing a better job of at least overlapping Thursday's value. So it's not you hit a switch and say, okay, it's one or the other. You're looking for indications of change occurring.
Okay, great. Thank you, Jim. There's a question here which I think reveals some other ways you look at the market. Say the market meandered up to the 2092.50 area. If you could mark that, I believe that's near the overnight high. I'm going to mark the overnight high. Okay. Would you put on a short trade, say with a 2-tick stop, given the slow tempo today? And Jim does talk a lot about how a market gets to a reference. We're using that information as well. And he's obviously on that. But do you have any comment for him about how you'd handle this type of list?
Remember, I said we talked about that book nonsense, and we said people have this great need for certainty and exactness. Okay. If it got to the overnight high, no, I would not automatically put a short on up there with a 2-tick stop. I mean, that's that desire for exactness. Now, but it depends how it got there. If the market really ground its way, trying to get there, and it's just really low tempo and stretching to get there, and it finally gets there, now I say, okay, maybe that context does, justify a short there. I don't think I'm going to be as exacting as 2 ticks, but maybe it would justify that. But let's say all of a sudden it turns right here and it roars up there with high confidence. Context is totally different. So now I wouldn't consider it. So everything has to, no real learning starts until you can view things within context. What we want to do, what kills people is they want exactness. They want to know exactly where they're going, where do I get out, where do I put my stop? And if it was that easy, those opportunities would be gone almost instantaneously. If it was that easy, it could be computerized. Once it's computerized, there's no opportunity for us anymore. Anyhow, but I understand the question. But it's not a crazy question. The overnight high is a legitimate reference for short-term traders, as is the overnight low. The question is, how does it get there? When I look at this morning, we're going to change times in 3 minutes. We're about in the middle of the early morning range. We're right about the point of control from Friday. No real change so far. Okay, let me recap very quickly. We start, and we're always trying to get a top-down look first before we come down to do our short-term tactical plan. Top-down, we looked in with the monthly, and the monthly bar showed us that we've basically been moving sideways for many months. And let me go back. We'll just put it up for a second. Well, let's go back to the charts. We've got it on the okay, there's the monthly. So we started on the monthly, and the monthly shows us that, remember, we said early on, many months ago, I said this could be the start of the market coming into balance. Remember, we said markets go bull, balance, bull, bull, balance, reverse to bear. Right now, it looks to me like we are in the balancing process, which is basic to what we have taught from day one, and the market right now on a monthly basis is in a multi-month trading range. Very little change over the past year. So we start with the monthly. That gives us a perspective. We see from a trade location standpoint, trade location is the best risk control element you're ever going to have. Trade location, we're up near the upper extreme. We then went, oops, excuse me.
You might want to go to the big screen, Jim. Just go from current slide up there under home, please. Thanks.
Okay, so now we see from a weekly, the market was one time framing higher, and then we've got basically a two-week balance. So that was our next thing. And guess what? We were in balance. We looked at the daily, and we showed that the daily was one time framing higher. We saw that Friday was a balancing day, so the question is, and you saw it in the report if you downloaded it, is there any cessation to one time framing higher? So far, no. Then we went to the daily, and we said, okay, it was a balancing day on Friday. Then we looked at the overnight, and we said the odds are we're going to open within Friday's range. Usually when we open within Friday's range, very little opportunity early on. You generally get a lot of chop. If there's an opportunity, it usually shows up later. So, and that's really where we are. There's been no real change this morning. I want to leave you this morning with a recommendation for serious traders. The book Nonsense was introduced to us by the institutional client that we work with every Sunday morning. I will say once again, it is the single most important thing I have ever read in order to mentally help me in trading. Traders have a tendency to want to be very mechanical. We know, all of us, no matter what, we like some stability in our life. We like some organization, and we don't really like change. But remember, trading is about change. Without change, that thing that we abhor, without change, there is no opportunity. Nonsense is about the power of not knowing. One of the things, there is no certainty in the market. You've certainly found that out. We've, for 15 months or so, we've moved sideways. Learning to deal with uncertainty is hugely important. Deliberately rethinking our routine assumptions. Let me give you an example of what I'm talking about is freeing yourself from the traditional type of thinking. This book does a wonderful job of it. And incidentally, if you get nonsense and read it, there'll be sections. There's a big section in the middle about retail merchandising, the stores, the gaps and things like that. And, I started to skim. Well, because it wasn't I didn't think it was as relevant to what I was looking for. And I said, no, it caught my attention. Do not skim this book. Read everything there is in it. But this idea of deliberately rethinking our routine assumptions, getting out of traditional way of looking at the market. One of the things that hit me this morning is we've been talking about this forever. We say a lot of times, very often, there is more important information in what didn't happen in the market rather than what did happen. And every trader in the world, I said, what happened in the market yesterday? Every trader in the world, they can tell you what happened in the market. And, because it's linear, it's past. Hey, they've got a great record of what happened in the market. I have a tendency to look at the markets much differently. I think that many times there's more information in what didn't happen than there is in what did happen. But our general line of thinking is to report to you on what did happen rather than what didn't happen. Let me go back to the slides for a second. And when I'm looking here and I'm saying, okay, what didn't happen? We didn't go back and revisit this very prominent point of control. These tell me that the market probably was very emotional. So what didn't happen? This inventory didn't get corrected. It's probably out of balance. Somebody said, what do you mean? Why do you think there's long risk? Because I think this inventory hasn't been corrected. So, what didn't happen? It didn't get corrected yet. And those are the kind of things that I'm constantly trying to change your thinking and the way you look at things. So let's go back and let's take a final look here before we say thank you, and I'll take just a couple of questions at the end. So we came in and we said the market was in balance this morning, and if there was any indication, any opportunities, they're probably going to be later. Now, look at this. We looked above the prominent point of control. We looked above unchanged. We found nothing above unchanged. The market started to sell off. We now have a poor low. A and B period have a poor low. In other words, when these are matching, that doesn't mean we won't rally from this, but when they match, this is what I call a poor low because there's no excess. There was no real aggressive buying on that low. So now the odds of going down and testing Friday's low have increased substantially. Are we there yet? No. Did I come in? Was I biased that I thought inventory was too long? Yes. We may be getting a correction of overnight inventory, but we're not out of balance. I'm sorry, we may be getting a correction of that inventory. But right now, as we leave, we are still within Friday's range. There is no change yet. Do I think the low is in for today? I think the odds are pretty low that we have a completion to the downside, yes, today. But this is not aggressive selling. This is not aggressive. You got some liquidation, but there's nothing aggressive in here. Market's now trying to rally to half back, which is a very common day time frame short-term traders reference. So right now, as I take the final two questions, we are within balance from Friday. There is no change has taken place yet, and we are just getting a greater sign of balance. We have a questionable low this morning. Anyhow, let me take two final questions, Julia. Julia, are you there?
Great. Thank you, Jim. No, I was just on mute. The underlying structure, you make the comment that it's weak. Um, one major observation is that the point of control hasn't been migrating higher with the price excursions, just like when you talked about the short covering rally that followed last week, with the price excursion lower, point of controls weren't migrating, closing on the lows, but the point of control was not migrating with it. Do you ever look at right now he's noting that many point of controls have not been revisited on the downside here. And he's also bringing in volume point of controls. Do you have any comment for him with regard to the volume point of control, and just to mention, that poor structure underneath, why that is one of the reasons why you think the market is
No, I don't. I
wrong?
think that no, I don't. I don't have anything to add to that. It's just a sign. The only thing I will add is here's one of the mistakes we make. We say, oh, uh, look at this. These point of controls haven't gone higher. The volume, the shape, and so many times where we go wrong as traders, we want to act too early. If I went back and I looked at my biggest mistakes over the years, they always involve acting too early. And it's like I said, remember, one of the examples I gave early on, there were four gaps to the downside when the market got down 5% not too long ago, and then it rallied all the way back.
Mm-hmm.
And yeah, the whole time down, I thought that there was a lot of risk. And when I wrote up because we do put reports out for a few people, and I wrote up, I've never seen four gaps in a row, and that's an indication to me that the market is probably emotionally very short. But, it come all the way back? Huge rallies when it got underway. But, you could have leaned into the wind and been out of money by the time the real opportunity was there. So recognizing the potential, just as I said on Friday, I elected not to buy early on Friday, even though I thought the market was going higher. I elected not to buy because I thought there was too much risk. Then the market came down on Friday later on. So I made a personal choice, but remember what I could have done. I could have shorted early, and I would have had a very difficult time. So I recognized the risk, but I also recognized that the trend was up. The trend was up, the momentum was up, and you don't fight that. The biggest mistakes we make are leaning into the wind. It's one thing to recognize the condition that is developing. It's another thing to pick the timing of when to do it. As I've said, right now, today, do we have a good low from today? No. Has anything really changed relative to Friday? No. Well, all we're getting is chop. Somebody asked about, longer term time frames. What do I see in there this morning? I don't see anything other than a lot of short-term trading so far. We went down, we left the poor low, we're going back up. We're still well within Friday's range. No change has taken place so far. There's what we call carrying information forward. Thursday's point of control, it hasn't been revisited. I'm carrying it forward. Does that mean that I have to act on it? No. But if the market starts to gain confidence to the downside, then my attention shifts to that very quickly. Okay, final question.
Yes, and just to mention to everyone, I put it in the message, but there are 2 daily reports at J. Dalton Trading at this webinar post. So under resources, webinars, upcoming webinars, you will find downloads for the 2 daily reports that Jim issues. And next Monday and the following Mondays, we will have those reports there. So please be looking for those. We do not email them for these webinars, but they are at our site. Also, Jim, do you want to comment? Right now, we did hover around half back. It's a rather novel reference you use. Many traders are not aware of it, but half back is basically simply the high and the low. You add the high and the low and you divide it by 2. It's the center of the range. It changes as the high and low expands. So you notice that B period you can see the half back line there. It's also near the opening price, but that B period did take some time to break through it. This is a very low confidence, conviction market. So I know my trading, I could get in a lot of trouble if I tried to engage this market. But Jim, the question is here, we have a poor low today, and we also have a weak low from the overnight low. Do you feel like that with the point of control is, increasing the odds of the market going in that direction?
I really don't have much consideration on the overnight low. That's not catching my attention. Basically, sometimes some of these questions are, sometimes people are leaning in, I want to do this, I want to do that. When I look at this market, I don't see any conviction either to the long side or to the short side. Do I like this low? No. Do I think it's a meaningful low? No. Could it come back through? Yes. But again, these are what we used to call local lows. They occur sometimes when there's just nothing other than very short-term traders in the market. I mean, now the high's not that good. You only got 2 ticks. So again, we make a lot of errors sometimes by leaning into the wind. So far, we are well within Friday's range. There is no indication of any confidence in either direction. Did I note this poor low? Yes, I did. Did I note it? Yes, it is. But and the overnight low and Friday's low, it's not that this is a weak low, because I really don't care that much about it, but it does add evidence. If we got down to this level, there's going to be stops relative to Friday and stops relative to overnight. So traders later on may get interested in going after this, because when the overnight low stop 1 tick short, you probably got an accumulation of stops there. But I don't think it's a tremendously significant reference. It just tells me, when I go exactly 1 tick short of it, it just tells me that the money in the market is generally very short term. I want to know, am I competing against short-term money, or am I competing against longer-term money? And more than likely, I'm competing against shorter-term money. Now I have a poor low and a poor high. Okay, listen, let me say thank you very much. Look forward to I hope you look forward to the announcements we've got coming out here in the next couple of days. I think when you see them, they are very significant to me, but they will be released shortly. Thank you all for joining us. This is the first of 5 free webinars, one for the roses, just indication, going into to year end, and we'll see you back here next Monday. Thank you all very, very much.
Great. Well, thank you, Jim. Thank you very much. We appreciate it, and thank you everyone for being here. We will have this recording uploaded a little later today, probably by about noontime. It'll be at the site, so please, you're welcome to that. And there'll be a reminder coming out on Friday for the webinar on Monday morning. Okay, and lots of fun news and exciting things coming out with us this week. So stay tuned and have a great day, everyone. God be with you, and we'll see you next Monday. Bye-bye.